we know that their stop loss is sitting right down here, and that would be a pivot target if we were shorting up here and looking at the previous highs back here. That was one of our pivot targets from today, actually, if we were longing down here, which we were. So understanding that, we just need to know that there's stop losses up there, down there. So we know if price is actually going higher, we would target those previous highs. And if it's going lower, it would target those previous lows.
Makes sense.
And the second most important thing to know, I guess it's not as much in the strat, but it's kind of built in, at least with how most people trade the strat. And we were kind of trading like this, even without understanding what another way, I guess it's called or utilized. But what I'm talking about is a fair value gap. So a fair value gap, it's abbreviated as FVG. It's going to be when you, let's say you have this big green candle to the upside, it's going to be this area between the high of this previous candle and the low of the candle that comes after it. So this, if we were to draw it out, that would be your fair value gap. And
all right, hold on, wait. You're doing that really fast. Hold on, slow, because hold on, you got to snare 3 up, and then so I got 3-2 up,
3-1, and then under this 1 and all the way to the high of this 2 right here that was failed 2 up in red. This whole entire area from here to here is your fair value gap. And you can see
value. Yeah, okay.
There's another one right here, and you can see another one right
so
here.
So when Rob says we like long red and green bars,
that's exactly why.
Okay.
Because so what this fair value gap does, and if you're trading the strat, I guess one way that you can kind of already see the way you're talking about it. So let's say you're taking this 2-2 reversal to the downside short. We know our pivot target is going to be right here. And we know the next target is all the way down here. So once we take out this one, we know there's exhaustion risk, and we know that when it hits that magnitude, it falls back in a large percentage
that's
of
the
the
other
time.
highs, test the highs, test the lows.
And right here, this is your 1 hour fair value gap, right? So those long green candles that Rob talks about, this is kind of built into that. So if we go and extend it out in time over here, this would be our fair value gap there. And all it shows is a place where prices traded incredibly quickly or aggressively through. And in theory, it is where you're going to have imbalances or orders that were yet to be filled or were not filled. And I'm not really going to talk about it too much, but it co-aligns also with, if you're looking at, I know a lot of people trade volume profile stuff using the strat as well. If you're looking at a volume profile, I don't know if I'm going to have the best example here. On like a 1 minute. If you're looking at a volume profile, it's going to be where in areas where you have that really low volume normally, but price kind of traded everywhere here. So not going to see it. But when you have those low volume nodes, it's going to be very similar idea and explanation, at least for it. So if we were to take a volume profile of this whole move, you would notice there's not much volume sitting here, which I'm not going to do it. It'll take too long, but just another thing to note there. And the importance of these is when you have prices that are trading higher, which is where we're going to talk about market structure in a second. But when we have prices that are trading higher, if prices trade into these fair value gaps, we look for them or expect them to reverse and continue in the direction they were trading previously. So if this traded all the way down here, we'd want to see it come and take out this high. In the same way that the strat would say, if we get this big old broadening formation, if we traded down to the bottom of the try, or at least took out these pivots,
right,
and got reversals with time frame continuity, we would want to take out these highs back here, these highs, and these highs.
Correct.
Very similar, because it's mostly trading the exact same type of ideas when it comes to liquidity. So most of it lines up. And so understanding the fair value gap and understanding liquidity, we know that if we get reversals, and ICT's reversals are slightly different, but we'll go over that in a second. But if we get reversals down here, we want to target liquidity up here. And if we get retracements into those fair value gaps on the way up, which if we go and look at this, you'll see you get a little fair value gap. If we go into a 2 minute, you had a little fair value gap in here, and you can see how that supported price and sent it higher, right? And then you had another one. It was in here. We actually didn't test it, traded higher. Another one ran under this low here into the fair value gap and traded higher. So we expect it to support the prices, or at least be areas where price will reverse from. And now the last thing is going to be market structure. So when talking about market structure, the way ICT defines it is, first of all, if you have, we'll draw out the boxes. So a swing high would be defined with 3 candles. So if you're looking at it like this,
What are we going over now? One more time.
But this is going to be market structure.
Okay.
So when defining swing highs and swing lows, which is how you make your market structure with highs, lows, and the smaller highs and lows, this is how it's defined. So we have a lower high on this side, lower high on this side, and a high on this side. So this would be a swing high. And vice versa, if we had the same type of look, like something like this, this would be your swing low. And this would be, you could call it a short-term low. So you don't really have to know how to differentiate between them, but that is how swing highs and lows are defined. So if we are looking at the S&P 500 on the 2-minute, you can see an example of that where we have like this red, I'll zoom in for it. We have this red candle, a low and a higher low here. This would be our swing low because we have higher low on either side of it. So understanding that, we can kind of draw out the market structure because we know this is going to be a major swing high and then it trades lower, and you had really short-term swing highs in here as well. And then it still trades lower, and you can see it trades higher, taking out all these swing highs. So if I were to be drawing this, just trying to draw out the market structure of it, we had a low, a high, we had another low, traded up, traded lower, took out those previous highs. And now when we see something like that happen, where we're taking out previous highs after we've gone and taken out lows, which this is gonna be hard to actually draw out on price. We'll just do it like this. So if we're trading lower and we see price go and take out those previous highs, then we kind of are looking at it. We're like, okay, well, if this move was aggressive, the one that came up and took out those highs here, then we know markets will trend in one direction and then they'll change and they'll trend in the other direction. So understanding that, if we have reason to believe price is going to try and be bottoming here, we would look to trade the swing low here as like a pullback, and this would be a reversal, but we'd look to trade it there and then trade it higher, targeting liquidity, 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 and liquidity, because now the market's starting to make higher highs and higher lows. And you can see that same idea of the swing low where we have a higher low and a higher low and a lower low to define our swing low. It's all fractal. So even just looking at this candlestick, this is on a lower time frame exactly what this swing low right here would look like. And for example, we'll actually go and look on it. So we'll run a 2-minute chart. We go to a 5-second or something. We can play the price action and you'll probably see the swing low form. And you can see this. So we get a low, we get higher low here, and now we get higher low here. And you could look at it at any of them. So you can see, like we were talking about previously with the structure, trade higher, breaks lower. Oops. I'll just go like this. Lower highs, lower lows, higher highs, creates a higher low where we'd look to trade it, and then trades higher, targeting liquidity and targeting liquidity, which you'll see. We'll take a second. Taking out all those different liquidity targets, which gives you your big old broadening formation that we know and love, right?